Ajay Vora, who's joining us on the show. He's, of course, the head of equities at Nuvama Asset Management. Ajay, hi, good to be speaking with you. Well, we were talking about a rural recovery when the monsoon was good and the elections got over. Hasn't really played out to that extent. And then we had the, hope pinned as far as the festive season is concerned, and the initial trends haven't been that supportive. Is there a risk that you see to earnings with the kind of consumption moderation that we are seeing?
Yeah, hi, good afternoon, and thanks for having me on the show. Yeah, so you are right to an extent because if you look at how the earnings at an aggregate level also have has shaped up since the start of the year, there has been an aggregate cut of somewhere anywhere between I would say 7 to 8% so far. And as of now, if you look at the trends at the ground level, that also is looking pretty muted. So we need to see over next 15 to 20 days because the moment we get into the festive season, that is when the whole consumption picks up. But my sense is that, considering the downgrades which we have seen across a few sectors, I think that, one has to be a little cautious considering the demand slowdown is for real at the ground level.
Sectors which you see the maximum, which are at maximum risk?
So it is across. So if you look at banks or even if you look at autos, both the sectors have seen reasonable cuts. And anyways, this quarter we are looking at sectors like metals and cement. They also will be reporting pretty muted numbers. So it's been across sectors within consumption also. I would say that consumption is a very broad basket, and therefore stock specific we have seen some sort of downgrades, but I wouldn't say that at an aggregate level there is a significant downgrade as such within the consumption basket.
Sure. Ajay, what's the take on IT then so far? Because it's also been somewhat of a mixed bag.
Yeah, so we have been a bit constructive on the whole IT sector, mainly because we believe that with the rate cut cycle getting aggressive over next few quarters, I think that the whole discretionary spend which was significantly there was a pent up demand on that can eventually flow through, and therefore if you look at the commentary of couple of companies which has reported numbers so far, and also a few mid-cap IT companies whom we generally talk to, it seems that the whole demand environment is now likely to get better and it has more or less troughed out. So we are a bit positive in that space, but obviously, we have to pick and choose stocks because some of the names are extremely expensive. But I think that within that space, still there is enough juice left, I think.
The point coming in as far as the IT sector is concerned, and what kind of outlook do you see for that? What about PSU as a basket? Because whether it was defense, whether it was those power financiers, whether it was the banking names, all had seen a massive rally. Now it's getting a bit sideways for them. What's the expectation from here on?
So within PSU also, it's a very large basket. So we are positive on few things. So as you said that, defense stocks, most of the stocks have corrected quite a lot over last 3 4 months. So my sense is that within that space, and it is a good structural story over next, I would say 3 to 5 years. So there will be certain opportunities in the defense sector where we are very positive. Another space within PSUs where we are extremely positive is the whole OMC space. I think that the whole blended margins, meaning the refining and the marketing margins put together, that can actually surprise the street over next 2 3 quarters. We are not very positive on crude, and therefore I think that OMCs will have that kind of leverage in terms of their marketing margins. So based on that, this whole OMC space, defense, and there'll be certain bottoms up, I would say, within metals also, because we are a little bit, tactically we are positive on the whole commodity space. So there are a few PSU metal companies where earnings can again surprise quite a lot. So there are certain pockets within PSU where we are extremely positive.
That's exactly the question that we posed to a commodity expert, Jonathan Bharat, as well earlier today, as to how the China story is going to really play out for metals and commodities as a cluster at large. Here's the opinion from him on where he sees oil prices and, of course, metals as well going forward.
When you look at Brent crude, there's a lot of support around that 70, 71, 72. West Texas is just a little bit lower than that. And if you remember the price action we had middle of last year, it just spent a lot of time bumping up and down from that 71, 72. So I think a 72, 77 range, and my risk is to the top side.
Okay, that's the take coming in on Brent prices. In the meantime, in fact, let's take a look at some of those, crude sensitives. We've been seeing the move on OMCs on one hand and the likes of ONGC and Oil India on the other. And then, of course, paints as a category as well is seeing a fair amount of sensitivity. Ajay, in light of your, view on OMCs, tactical as it may be, do you think the other crude sensitives, paint and the allied themes, tires, etc., as well, make for a good tactical play?
Yeah, definitely. So we are again, positive on paints and tires, both the sectors. Paints actually, if you look at it, over last 3 years, broadly, I would say 100, 120 million square feet, kind of, entire residential space has been sold out by the all the organized developers, which I think will be up for possession starting maybe December or maybe a couple of quarters down the line. And therefore, we are extremely positive considering, if the crude stays here. I think the paint demand also can surprise over next 2 to 3 years. And secondly, on the tire space also, if you look at it, large part of the capex is getting over for them. And most importantly, earlier their margin profile used to be in single digit. Now most of the companies have moved to anywhere between 12 to 15% margin. And if raw material prices stay lower, especially on the crude side, because the rubber prices are still higher, I think that there is a room for better margins going forward in this space as well. So stocks are extremely cheap, I feel, especially a couple of tire companies. And with better margin profile and better ROE profile, there is room for re-rating as well.
So that's a view coming in on some of these stocks, but let's take a quick look at the market right now. And of course, you have on the gaining side the AMCs which are doing well. Amber Enterprises is holding up. Nuvama Wealth has joined that AMC party, and then BEML as well. And Voltas too is actually doing quite well for itself. Just wanted to get a better sense from you, Ajay, as far as the financials are concerned. The large caps have finally started participating. I mean, this week, if you look at it, you have HDFC Bank, which is up over 3%. ICICI Bank was doing well for the last 1 week thereabouts. Is it a time to tactically allocate more to financial services and large cap banking at that?
See, I think that overall banking space, if you look at it, the top line growth and the bottom line growth is not very impressive, especially in the upcoming quarter. So there can be some more time pain to this sector. But I think that for someone who is taking 2 to 3 year kind of a view, these levels and these valuations, I think, is a good entry point. One may not get a significant up move in the medium term, but I think large part of the overhangs are getting over now. And my sense is that the valuation comfort is pretty significant. So banking definitely looks good, but over 2 to 3 years, I don't think over next 1 or 2 quarters, because the numbers are not going to be that impressive. It may continue to be a laggard.
Right. So where is it, Ajay, that in this current market you're underweight?
Yeah, we are underweight on the banking space.
Okay. That's about it. Let's just take a look at where, in fact, banks are up to. While HDFC Bank is holding up right now in trade, let's see what the rest of the pack is up to, because SBI is fairly muted right now. ICICI Bank, we should bring up that intraday graph. Axis as well, relatively tempered in trade, not doing a whole lot. Kotak, of course, is in the red as we speak right now. And that's pretty much the case with the smaller banking names as well. Kunal, a quick call on the Nifty Bank and where you see that headed right now. And if you could just bifurcate as to where you see the large cap banking pack, HDFC, ICICI, etc. as well.
So the only three names on the large cap side which are still showing signs of strength. First one is, of course, ICICI Bank. That's a chart which is still holding on to its 50-day moving average relatively. The stock in the last 3-4 months was one of the strongest in terms of price performance. So it still continues to be one of the better performing names from the private sector banking names. Now, of late, in the last 4-5 days, we've seen Kotak Bank started to get back into a very strong recovery. So the stock recovered almost 100 to 150 points from sub 1800 levels to 19, 20, 30 approximately, the stock which made a swing high couple of days back. So that's another chart to look out for. Even though the stock is down today 0.5% or 1%, I would still believe that that's a very good territory to go for a contra long on Kotak Bank, because such kind of renewed momentum, even if it leads into maybe a couple of days of price retracement, it eventually leads into a breakout for stock prices. HDFC Bank could be the third stock to look out for. So I think in terms of priority, I would probably look out for, from a short term view, I would look out for Kotak Bank, ICICI Bank and HDFC Bank as better placed charts from the private sector banking names. And even for the bank Nifty relatively, so we are at a point where the Nifty is trading slight below its 50-day moving average. Bank Nifty is trading above its 50-day moving average. So even in terms of the sectoral strength, Bank Nifty is showing that relative strength for itself as compared to the benchmark indices. So I would probably place a support for the Bank Nifty closer to that 51,300, 350 mark.
Right, okay, that's the take coming in on banks. In fact, Ajay, we let you go on that note. Good to have you on the show as always.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.